We usually think of gold as, the ultimate financial panic room.
Right.
You lock the heavy steel door, you hunker down, and you basically just wait out the storm of a global conflict.
Exactly.
But, what happens to the panic room when the danger actually starts to pass? Welcome to today's deep dive. It is Saturday, May 9, 2026.
Glad to be here.
Our mission today for you, the listener, is to deconstruct this highly counterintuitive financial puzzle. We're looking at why Middle East peace talks, specifically, the ongoing, highly scrutinized diplomatic efforts between the U.S. and Iran, are exerting such a massive, hidden gravitational pull on the price of gold.
It's a huge shift.
It really is. And to figure out the mechanics of this, we are pulling apart a core piece of research today. It's an article titled, "So What Do Peace Talks Mean for Gold?" by financial markets researcher Doug Young.
And that was published in the Gold IRA Company's bulletin, right?
Yeah, exactly. And we're also weaving in some peripheral market action from this week. There was a very sudden, massive spike in silver, some revealing new institutional data on retirement savings, and, well, some pretty heavy losses in the digital asset space, too.
Yeah, a lot of moving parts this week.
Right.
Yeah.
Okay, let's unpack this. Because the foundational assumption that drives retail investment is that gold equals safety from war.
Yeah, and that historical precedent is deeply ingrained in market psychology. When geopolitical uncertainty spikes, capital immediately seeks a tangible, non-counterparty store of value.
Right. People just want something real to hold on to.
Exactly. But the research we're analyzing today points to a pretty severe blind spot in that conventional wisdom.
Oh, really?
Yeah, because financial markets, especially at the institutional level, they don't just respond to the kinetic reality of a conflict. They are actually trading on the trailing economic shockwaves that the conflict produces.
But wait, if we apply basic market logic here, if diplomatic channels are opening up between the U.S. and Iran, and peace talks are gaining traction, the panic room should be emptying out, right?
You would think so, yeah.
Gold prices should be plummeting as the fear premium just evaporates. Yet, if we look at the actual trading data, gold jumped 3.31% a couple of days ago on May 7th, right in the middle of these high-level negotiations.
Yeah, it caught a lot of people off guard.
The math just isn't mathing there. Why is the ultimate safe haven asset rallying when peace is actively on the table?
What's fascinating here is that gold is never priced in a vacuum. And it certainly isn't just some crude fear gauge.
Right.
It functions much more like a mirror. It's reflecting a highly complex matrix of broader macroeconomic sentiment.
Like what, specifically?
Well, specifically, economic growth projections, currency valuations, and anticipated monetary policy. When sovereign wealth funds and institutional traders analyze the U.S.-Iran situation, they aren't just reading the diplomatic press releases.
They're looking deeper.
Exactly. They are constantly running probability models on the risks tied to sanctions, the potential for supply chain blockages, and massive shifts in global trade routes.
I see.
They are aggressively pricing in those changing variables long before any formal treaty is actually ratified.
So they're essentially trading the future. The markets move on expectations of how the architecture of global commerce will, physically change once the ink is dry.
Yeah, exactly. If investors expect a genuine diplomatic breakthrough, the algorithm shifts immediately. The geopolitics alone, like the visual of leaders shaking hands, that does not dictate the spot price of gold.
Right. It's not just about the photo op.
No, not at all. It's the subsequent recalibration of those massive economic variables. The moment de-escalation seems probable, the market instantly begins calculating the sheer volume of friction that will be removed from the global economy.
And when we talk about friction in the Middle East, we are immediately talking about the most critical transmission mechanism in the global economy, which is energy.
Absolutely.
You're talking about the oil markets.
Yes. And Doug Young's research isolates this as the primary, most vital channel linking these specific peace talks to the gold market.
Right.
The transmission cable connecting a geopolitical summit to a precious metal isn't the concept of fear. It is the physical barrel of crude oil.
So oil is the transmission cable.
Yes.
A diplomatic de-escalation effectively cuts that cable. The risk premium on oil drops, inflation subsequently drops, and gold loses its primary fuel source.
That visual maps perfectly onto the institutional trading behavior we are seeing. If diplomacy actually reduces the threat of a wider U.S.-Iran conflict, the very first action energy traders take is to price out the supply shock premium.
Because they aren't panicking about disruptions anymore.
Right. They no longer have to pay inflated futures prices to hedge against, say, a suddenly blocked strait or a drone strike on a major refinery.
Wow, yeah.
And as that geopolitical risk premium evaporates, the baseline cost of crude oil begins to ease.
And crude oil prices, they bleed into the core operating costs of literally every sector.
Every single one.
It dictates the margins for global shipping conglomerates, the logistics networks, the agricultural sector. Cheaper crude inevitably softens the cost of goods sold across the board.
Which introduces a massive deflationary pressure, or at least it significantly cools down the prevailing inflation metrics.
Right.
And this is the critical nexus for gold. In the modern financial era, gold is utilized structurally as an anchor of purchasing power when inflation is eroding fiat currencies.
Because it's outside the system.
Exactly. It is a physical, tier 1 asset outside the purview of central bank printing presses.
You're tracking capital flight to stable assets, and we are actually seeing the fallout of this exact shifting dynamic in real time across the alternative asset space.
Oh, definitely.
Look at the earnings data that just dropped yesterday with Coinbase. They're facing a $394 million loss.
Yeah, that was brutal.
The crypto market is enduring these wild, violent liquidations right now. It really proves that when the macroeconomic picture gets complicated and inflation variables are actively shifting, institutional capital just doesn't fully trust high-beta digital assets.
No, they don't.
They rotate back to the proven historical stability of physical gold.
The volatility in digital assets right now serves as a perfect foil. When macro allocators are attempting to hedge against shifting inflation expectations, they require an asset with deep liquidity and structural permanence.
Not one prone to massive algorithmic drawdowns.
Exactly. However, tracing that oil connection further, if these peace talks successfully suppress oil prices and those lower energy costs reliably cool down sticky inflation data, the traditional mechanical demand for gold as a pure inflation hedge should theoretically weaken.
Which brings us right back to the May 7th anomaly.
Right.
If the oil-driven inflation threat is cooling down because of successful diplomacy, gold should still be dropping. But like we said, it rallied 3.31%.
Well, if we connect this to the bigger picture, we have to examine the reactionary mechanics of central banks.
Okay, how so?
Easing inflation pressure is the exact leading indicator that central banks, particularly the Federal Reserve, require to alter their monetary policy.
Oh, wow.
And that dynamic sets up the ultimate driver of the gold market.
You're talking about the real yield spread.
Yes.
This is the interest rate trap where gold investors actually make their money.
This is the ultimate competitive battlefield. When you strip away the romance of holding precious metals, you are left with one glaring structural disadvantage.
Which is?
Gold yields nothing. It produces no quarterly dividend, it generates no earnings report, and it pays no coupon.
So holding it requires accepting a significant opportunity cost.
Absolutely.
If institutional capital is parked in a massive gold position, that capital is actively choosing to forego the guaranteed, risk-free return of a U.S. Treasury bond.
Yes, that's exactly the trade-off.
When real yields are surging, meaning the nominal interest rate is sitting significantly higher than the inflation rate, the penalty for holding a dormant asset becomes incredibly steep.
And that is the exact mechanism that shapes weak hands out of the gold market. Why hold a non-yielding metal when the government is offering you a highly attractive risk-free yield?
Right. So what does this all mean for you, the listener? Let's bring this macro theory down to the level of actual applied portfolio architecture.
That's a great pivot.
When we look at the data on who is successfully navigating these complex shifts, there's a recent Goldman Sachs survey. It found that Americans who utilize a personalized retirement plan hold 27% more in savings.
That's a huge difference.
That is a massive statistical advantage, and it comes from optimizing for these exact yield environments.
Exactly.
If I'm operating at that savvy strategic level, modeling out my long-term wealth protection, why would I allocate capital to a non-yielding asset like gold? Especially when peace talks are actively de-risking the global landscape.
The answer lies entirely in the projected trajectory of those yields. Let's run the sequence of dominoes from the beginning.
Okay, let's hear it.
Diplomatic progress in the Middle East eases the risk premium on oil. Lower crude prices eventually bleed into the CPI data, reducing aggregate inflation fears.
Right.
When inflation decisively cools, central banks are suddenly granted the political and economic runway to pause aggressive rate hikes, or more likely, begin a cycle of cutting interest rates.
And the moment the Federal Reserve signals a rate cut, The yield on those competing treasury bonds starts to collapse.
The opportunity cost evaporates. If peace softens the upward pressure on interest rates, the mathematical penalty for holding gold basically disappears.
Wow.
This creates a remarkably favorable macroeconomic environment for gold to thrive as a foundational anchor in a diversified portfolio.
So the May 7th rally wasn't the market pricing in the fear of a collapsing peace summit at all.
No, not at
Well,
all.
it was the market pricing in the probability of a lower interest rate environment driven by that peace.
Precisely. The market isn't reacting to the diplomats in the Middle East. They're looking right past them to the central bankers in Washington.
Anticipating the sigh of relief that allows for looser monetary policy.
Yes. The friction between the geopolitical narrative presented on the evening news and the actual structural plumbing of the financial system is immense.
It's like two different worlds.
It really is. Retail investors trade the headline, but institutional investors trade the liquidity environment the headline creates.
Here's where it gets really interesting, because that disconnect creates a wildly chaotic environment for the average observer.
Oh, completely chaotic.
You have algorithmic day traders sweating over every single push notification on their phones. A headline crosses the terminal saying, "Diplomatic talks stalled," and the algorithms buy gold on the immediate fear impulse.
Right.
An hour later, a headline reads, "Ceasefire imminent," and they dump the position. I mean, it is pure reactive noise.
Those hyper short-term reactions are entirely driven by momentum and sentiment. A perceived breakthrough triggers a rapid, knee-jerk liquidation of safe haven positions.
And a sudden setback violently reverses the flow.
Exactly. But managing a portfolio based on daily chart swings is a losing battle against the tectonic plates shifting underneath the global economy.
Which is why relying on deep structural expertise is so vital when evaluating a market this opaque.
Absolutely.
The author of our primary source today, Doug Young, isn't just writing reactionary blog posts. We are talking about someone with over 2 decades of applied experience in financial markets.
He knows what he's talking about.
He spent 16 years operating as a financial director at World Freight Services, which means he intimately understands how global supply chains and energy costs interact.
That supply chain experience is key.
Furthermore, he's evaluated over 80 gold IRA companies since 2011. He doesn't look at a peace treaty and stop his analysis there. He's looking at the underlying macroeconomic rot.
Analyzing the market over a 5, 10, or 20-year horizon requires entirely ignoring the daily diplomatic theater.
Right.
While algorithmic traders react to the tone of a peace summit, long-term allocators are scrutinizing sovereign debt issuance. They are analyzing the trajectory of massive unfunded fiscal deficits.
They're real structural issues.
Yeah, they are modeling out the inevitable currency devaluation required to service that massive debt.
Even if the U.S. and Iran sign the most comprehensive, bulletproof peace treaty in modern history tomorrow, it does not erase the fact that the United States is running a multi-trillion-dollar national deficit.
Not at all.
The underlying systemic mechanics of fiat currency debasement haven't been resolved just because a specific geopolitical tension was temporarily neutralized.
This raises an important question regarding how we interpret market terminology, particularly when the incoming signals are this contradictory.
Like what?
Well, when you have localized geopolitical de-escalation occurring simultaneously with systemic massive government deficit spending, how do we accurately define what a favorable market for precious metals actually looks like?
We really need to redefine the term bullish. The financial media throws that word around constantly. Is gold bullish right now? But they treat it like a crystal ball prediction rather than an environmental description.
And that misuse of the terminology is a major trap for retail investors.
Totally.
In strict market language, a bullish environment does not represent a guarantee of future returns. It does not mean an asset is destined to appreciate linearly.
Right, it's not a sure thing.
No. It simply denotes that the underlying structural conditions have aligned in a way that may be favorable for price discovery. It is an entirely conditional setup.
It's like analyzing the soil conditions, not guaranteeing the crop yield.
That's a great way to put it. A bullish setup for gold exists today because the possibility of peace lowers the systemic inflation risk, which in turn softens the pressure on nominal interest rates, thereby reducing the opportunity cost of holding the metal.
Right.
However, that entire conditional architecture can collapse in a matter of days if inflation suddenly spikes due to a completely unrelated factor, or if the peace negotiations break down and energy markets panic all over again.
And those conditional macroeconomic setups don't operate in a vacuum either. The liquidity flows they generate bleed heavily into the broader precious metals complex, particularly the high beta assets.
Oh, absolutely.
We saw the proof of concept for this entire theory just 2 days ago. While gold was logging that impressive 3.31% jump on May 7th, silver absolutely exploded.
Yeah, that was wild to watch.
It soared 9.97% in the exact same trading session.
Silver functions with a much higher beta, meaning it is significantly more volatile, but it is ultimately responding to the exact same macroeconomic dominoes.
It's the same fundamental drivers.
Exactly. When the environment flashes conditionally favorable, when that specific bullish real yield setup emerges, institutional capital flows aggressively into tangible assets, and silver catches a massive tailwind.
Right.
But the overarching takeaway from Doug Young's methodology is that you can never reduce this dynamic to a binary soundbite.
You cannot simply say peace is bad for gold because the fear premium is gone.
Yeah.
Just like you can't say peace is good for gold. So if this relationship isn't a mechanical switch that you can just flip based on a news alert, how should a savvy learner, someone optimizing that personalized retirement plan we talked about, apply this to their own financial worldview without drowning in the variables?
The practical application requires a fundamental shift in your analytical framework.
Okay.
The objective is to stop observing geopolitical events in isolation. When a major headline breaks regarding diplomacy, military conflict, or international sanctions, the immediate question should never be, what does this mean for the price of gold?
Right.
The question must be, what specific macroeconomic dominoes is this event about to knock over?
You have to map the transition cables.
Track the crude oil futures, monitor the sticky inflation metrics, analyze the forward guidance from central bank interest rate committees.
Look at the actual plumbing.
Yes, those are the actual physical gears driving the machinery of the global economy. Diplomacy merely alters the economic variables. The
Yeah.
variables dictate the capital flows.
Makes perfect sense.
Once you adopt that lens, you insulate yourself from the emotional churn of the daily news cycle and begin analyzing the financial architecture strategically.
It effectively removes the mystery from the market movements. Let's briefly recap the massive amount of ground we just covered today.
Sounds good.
We started with the surface level narrative, Middle Eastern diplomacy, the U.S.-Iran conflict, and the retail assumption that peace immediately kills the demand for a safe haven asset like gold.
Right, the panic room theory.
Exactly. But then we mapped the transmission cable straight into the energy markets. We observed how diplomatic de-escalation removes the supply shock premium, driving oil prices down.
Yes.
That cheaper crude acts as a deflationary force, cooling the broader economy, which ultimately relieves the pressure on the Federal Reserve to maintain punishingly high interest rates.
And because gold carries the structural burden of offering zero yield, a transition into a lower interest rate environment removes its primary headwind, making it a highly competitive institutional asset once again.
Right.
This fundamentally redefines a bullish market. It is not about trading the fear of war. It is about positioning for favorable macroeconomic conditions.
For anyone listening who wants to bypass the talking heads and dig directly into the factual data behind utilizing precious metals as a strategic portfolio anchor, particularly regarding retirement structuring, I highly recommend checking out the Gold IRA Investment Resource Guide.
It's a great resource.
You can find all of this at goldiracompaniescompared.com. It operates as an excellent hub for the exact caliber of structural research we've been unpacking today. Again, that's goldiracompaniescompared.com, and we will absolutely link that in the show notes for this deep dive.
It really provides the necessary framework to translate these abstract macroeconomic concepts into applied long-term wealth protection strategies.
Before we wrap up, I want to leave you with one final lingering concept to model out on your own this week.
Oh, this is a good one.
We just spent a lot of time discussing how peace reduces the geopolitical fear premium and how that subsequent drop in inflation and interest rates can create a bullish setup for gold.
Right.
The research noted that if investors simultaneously expect weaker economic growth alongside that policy easing, gold finds massive structural support.
Yeah.
So imagine the ultimate contrarian scenario. A comprehensive, historic peace treaty is signed. The geopolitical fear vanishes entirely. But without the massive government spending required by conflict, the global economy suddenly stalls out. Does your gold position instantly pivot from being a dedicated inflation hedge to functioning as a recession life raft?
That scenario truly tests the elasticity of your portfolio, and it challenges how adaptable your understanding of wealth preservation really is.
Does the panic room seamlessly convert into a lifeboat when the water starts rising? Keep that question in mind as you watch the institutional capital flows react to the headlines this week. Thank you for joining us on this deep dive.
Thank you for your time. Keep questioning the consensus.
We'll see you next time. Keep learning.